Here's something that quietly happened over the past 12 months. Nvidia stayed in every headline, but in the background, a copper mining ETF returned over 120%. An AI power infrastructure fund, one that barely existed a year ago, surpassed $500 million in assets in under 10 months and was named Best New Thematic ETF of 2026. And a broad AI ecosystem ETF quietly returned over 50%, while most investors were staring at a handful of the same mega-cap names. The AI boom didn't just happen in one place, it spread. And a lot of investors, even smart ones, missed the branches because they were staring at the trunk. So in this video, I want to walk you through 4 ETFs I'd actually own right now for AI exposure. Not because they're trending, but because each one captures a completely different part of this story. And together, they cover ground that most portfolios are still leaving empty. Here's the framework. 4 ETFs. 4 distinct angles on the AI economy: broad ecosystem exposure, physical power infrastructure, raw materials, and cybersecurity. One for each layer. I'll walk you through what's actually inside each fund, what the numbers look like today, and importantly, what the real risk is. No hype, just the thesis. By the end of this, you'll have a clearer map of the AI investment landscape than most people who've been following this space for years. Let's get into it. The default move for most investors who want AI exposure is simple. Buy Nvidia, maybe Microsoft, maybe Alphabet. Stack a few big tech names and call it covered. And look, those aren't bad companies, but here's the problem. A standard S&P 500 index fund already gives you heavy exposure to all of those names. So if you're buying more of the same mega-cap tech to add AI exposure, you're mostly just concentrating risk you already have. The more interesting question is, where is AI creating value that the market hasn't fully priced in yet? Where are the second and third order effects still being underweighted? That's the whole point of this video. ETF number 1, AIQ, Global X Artificial Intelligence and Technology ETF. This is your broadest lens on the AI space. The fund holds 84 positions across software, semiconductors, cloud, automation, and digital infrastructure. Top holdings include SK Hynix, Micron, Samsung, AMD, Apple, Cisco, Taiwan Semiconductor, and Amazon. The top 10 names make up about 35% of the fund, which is actually a moderately concentrated portfolio for an 84-stock ETF. Over the past 12 months, AIQ has returned approximately 50%. Assets under management are now around $10.9 billion. What I like about AIQ is that it looks different from a standard tech index. You're getting meaningful international exposure, including Asian semiconductor names that don't show up in a typical S&P 500 fund. That geographic breadth is part of the value here. The expense ratio is 0.68%. That's on the higher side for a passive ETF, worth knowing up front because that cost compounds over time. The performance has justified it, but you're paying more than you would for a generic index fund. Think of AIQ as your foundation. It's the widest view of the AI story. Here's where I want to slow down, because there's a gap in how most people are thinking about AI right now. When investors say AI exposure, they usually mean software, chips, and cloud. But almost nobody is talking about electricity. AI is one of the most power-intensive technologies ever deployed at scale. Hyperscale data centers are being built across the US, Europe, and Asia at a pace the existing power grid was never designed to handle. That creates an urgent structural demand for energy infrastructure: transformers, cooling systems, power generation equipment, grid expansion hardware. S&P Global published a report earlier this year titled "Copper in the Age of AI: Challenges of Electrification." The title alone tells you something is shifting in how the market is starting to frame this. This is the part of the AI story that most retail investors are dramatically underexposed, and it leads us to ETF number 2.
ETF number 2, AIPO, Defiance AI and Power Infrastructure ETF. AIPO, the Defiance AI and Power Infrastructure ETF, launched in July 2025. It's one of the newer names on this list, but it's already been named Best New Thematic ETF at the ETF.com Awards for 2026. Assets have grown to nearly $800 million in under a year. What's inside? The top holdings include Quanta Services, Vertiv, GE Vernova, Eaton Corporation, Bloom Energy, Broadcom, Cameco, NVIDIA, and Constellation Energy. 78 total positions. The top 10 account for around 50 to 55% of the fund. Expense ratio is 0.69%. Look at that list carefully. These aren't software companies. They're the companies building the physical backbone of the AI economy. Electrical grid infrastructure, power systems, data center hardware, energy generation. Industrials make up over half the fund. That's the point. The AI build-out is a construction project as much as it is a software project, and the construction side of this trade is still being underweighted by most investors. Now, being a newer fund, you don't have a long performance history to evaluate. That's a real limitation, but the thesis is structural, and the underlying names are directly tied to a capital expenditure cycle that every major hyperscaler is still accelerating. ETF number 3, COPX, Global X Copper Miners ETF. Now, here's one that might stop you for a second. COPX, the Global X Copper Miners ETF, a basket of mining companies. And yes, I'm including it in an AI video. Here's why. Copper is the connective tissue of the entire AI infrastructure story. Every data center, every power transmission line, every server rack, every EV charger being built right now requires copper. You cannot build the physical internet of AI without it. S&P Global estimates copper consumption could reach 42 million metric tons by 2040, up from about 28 million today, and the AI infrastructure build-out is a significant driver of that gap. Over the past 12 months, COPX has returned approximately 122%. AUM is around $8.5 billion. The fund holds 46 positions, a concentrated mix of global copper miners with names like Freeport-McMoRan, Glencore, BHP, Southern Copper, London Mining, and Antofagasta. The top 10 make up about 52% of the fund. Now, let's be direct about the risk because it's real. Copper miners are volatile. They're tied to commodity prices, geopolitical exposure, and operational risks specific to mining. This is not a low volatility position. A significant slowdown in infrastructure spending or a broad commodity pullback will hit this fund. But if you believe the AI build-out is a multi-year capital-intensive cycle and the data continues to support that, then copper is a genuine play on that thesis. Not just a commodity bet, a second-order infrastructure bet that most investors are still mapping to the old economy. Let's step back and look at what we've built so far. A broad AI ecosystem ETF, an AI power and infrastructure ETF, a copper miners ETF. 3 different industries, 3 different risk profiles, 0 overlapping top holdings, all tied to the same underlying economic shift. That's the point. The AI opportunity isn't a single trade, it's a system. And the fourth piece of that system is one that most people have been actively selling at exactly the wrong time. Bug, the Global X Cybersecurity ETF. And this one has a story that's worth understanding clearly. The fund's one-year return is roughly minus 5%. That's a loss, not a flat line. Cybersecurity stocks got punished hard, down significantly from their highs. Investors started pricing in a narrative that AI models would automate most of what these companies do, that machine learning would make Palo Alto Networks, CrowdStrike, and Fortinet obsolete. The sell-off was real. That thesis turned out to be wrong, or at the very least, badly incomplete. Here's the reality. AI doesn't reduce the need for cybersecurity, it expands it. More AI systems running autonomously means larger attack surfaces. AI-enabled attacks, where autonomous systems identify and exploit vulnerabilities at scale, are an emerging threat category that security researchers are now calling agentic attacks. More automation means more entry points. Enterprise security spending isn't slowing down. According to Gartner, it's on track to hit $215 billion in 2026. Bug currently has around $870 million in AUM,
30 holdings, an expense ratio of 0.51%. Top positions include Palo Alto Networks, Akamai Technologies, Fortinet, CrowdStrike, SentinelOne, and Okta. The top 10 make up about 62% of the fund. The 52-week range tells the story clearly. The fund went from a high of $37.55 all the way down to a low near $23 before staging a meaningful recovery. That's a wide range for an ETF, which means this is not a smooth ride. But it's also why the forward opportunity exists. You're buying back into a structural growth theme after a significant repricing. The framework. Here's the complete picture. AIQ, broad AI ecosystem, software, chips, cloud, automation, global coverage, your widest lens. 50% return over the past year, $10.9 billion in AUM. AIPO, AI power and physical infrastructure, grid equipment, energy systems, data center hardware, best new thematic ETF of 2026, nearly $800 million in AUM in under a year. COPX, copper miners, the raw material backbone of AI infrastructure, 122% one-year return, $8.5 billion in AUM, high volatility, high exposure to the physical build-out. Bug, cybersecurity, down roughly 5% over the past year, which is the entry argument. $870 million in AUM, the protection layer that becomes more critical, not less, as AI scales. 4 different industries, 4 different risk profiles, near zero overlap in top holdings, same macro trend. A few things worth keeping in mind before you act on any of this. First, you don't need all 4. The goal isn't to own every ETF on this list. It's to figure out which part of the AI story your portfolio is currently missing. If you're already heavy in mega-cap tech, AIQ adds less diversification than you might expect. AIPO or COPX might fill a bigger gap. Second, expense ratios matter over time. AIQ at 0.68% and AIPO at 0.69% are real annual costs. Bug at 0.51% is more reasonable. Make sure what you're getting in exposure justifies what you're paying. Third, know what you own. COPX is a volatile commodity play. Bug had a rough 12 months. AIPO is a brand new fund. None of these are set and forget. They're thematic positions that require you to stay engaged with the underlying thesis. And fourth, the biggest mistake here isn't picking the wrong ETF. It's picking one angle and thinking you've covered the whole story. The investors who will do best with AI over the next decade are the ones who understand that this isn't a trend. It's a structural rebuild of the global technology economy, and structural rebuilds affect everything. The AI boom started with a handful of chip stocks, but the opportunity was never really about one company or one sector. It was always about what gets built as a result: the power systems, the physical infrastructure, the raw materials, the security layer that makes all of it defensible. Most investors are still thinking about AI like it's a single trade. The ones paying attention are starting to treat it like a decade-long infrastructure cycle. That's a very different investment thesis.